Picture two people, same job, same salary, same monthly savings. 30 years later, one is comfortable, the other is not. The difference is not luck. It is not a lucky stock pick. It is one decision, made once, early in life, or never made at all. What happens when you never invest? The math is not complicated. The result is, and millions of people are living it right now without realizing. Two people, two choices. Person A earns a reasonable income. They save $500 every single month. That money goes into a standard savings account. Safe, stable, earning almost nothing. Person B earns the same income. They save the same $500 per month. But person B puts that money into a low-cost S&P 500 index fund every month. Automatically, the S&P 500 has averaged roughly 10% per year over its history. That average holds across 5 full decades of data. It includes recessions, it includes market crashes, it includes every financial crisis since the 1970s. The 10% average survived all of them. For this simulation, we use 10% annual return with monthly compounding. Taxes and platform fees are excluded. The goal is to isolate compound growth in its purest form. Both people start saving at age 25, both continue until age 55. That is 30 years. This is not about picking the right stock. This is not about timing the market. This is about the most underestimated force in personal finance, compound interest, and the price you pay for ignoring it. In year one, not much happens. Person A has saved $6,000. It sits in the bank. Person B has invested the same amount. The portfolio is now worth about $6,300. $300 difference. Easy to ignore. Year 3 arrives. Person A has saved $18,000. Person B's portfolio has grown to about $21,000. $3,000 gap. Still easy to dismiss. Still easy to tell yourself you will start investing soon, when things calm down, when you earn more, when the timing is better. But compound interest does not wait for convenience. It runs continuously. Every day, every month, every year. Whether you are watching or not. Year 5. Person A has $30,000. Person B has about $38,000. An $8,000 gap. Growing. Not from new money. From the money already invested. Year 10 arrives. Person A has $60,000. Person B's portfolio has crossed $100,000. A $40,000 gap. From the same income, from the same savings rate. The only difference is where the money went every month. Most people reach this point in their financial lives and wonder where the decade went. Person A is wondering the same thing, but person B is not. Year 10 is where the math starts to accelerate. Person A keeps saving steadily. The balance climbs, but it only grows as fast as the monthly deposits allow. Person B's portfolio is now large enough that the investment returns have started to outpace the contributions. The interest is earning interest. The growth is compounding on top of itself. This is the moment compound interest becomes visible, and it is relentless. Year 15 arrives. Person A has $90,000. Person B now has over $200,000. The gap has crossed $100,000. Think about what that means. Person B is carrying an extra $100,000. Not from working harder, not from a raise, not from a lucky investment, from compound growth running uninterrupted. Year 20. Person A has $120,000. Person B's portfolio is approaching $380,000. The gap is now $260,000. $260,000 sitting on the sidelines. Not because of bad decisions. Not because of market crashes. Because the money went to a place that did not grow. There are no winning trades in this simulation. No hot tips. No lucky timing. No inheritance. Person B's advantage is built entirely from one thing. Monthly contributions. Low-cost index fund. Time. That is it. That is the whole strategy. The last 10 years are where the simulation becomes difficult to watch. Year 25 arrives. Person A has $150,000 saved. A quarter century of discipline. 25 years of consistent saving, and the number feels too small. Retirement is a decade away. Social Security will cover some expenses, but $150,000 is not a retirement fund. It it is a starting point at best. Person B's portfolio has grown to about $660,000. The gap at this point is enormous. Over $500,000 separate the two outcomes, and the final 5 years are still ahead. They are the most powerful years in the entire 30-year run. The portfolio is at its largest. Every single percentage point of return generates more raw dollars than at any previous point. The 30-year mark arrives. Person A crosses the finish line. $180,000. Every dollar saved is there. Safe, no losses, no volatility. Just the money that went in. Person B has crossed $1 million. 1.1 million against 180,000. The gap is nearly $1 million. Person A put $180,000 of their own earnings into that savings account. Person B put in the exact same amount. But Person B also received $920,000 in compound growth on top of that. That $920,000 did not come from labor. It came from patience. The savings account problem is actually worse than the simulation shows. Cash does not sit still. Prices rise every year. Inflation has averaged around 3% annually over the long term. That sounds small. Over 3 decades, it is not. Inflation averages around 3% annually over the long term. That sounds small. Over 30 years, the damage is severe. Cash loses more than half its purchasing power over that span. A bill in your wallet is still there, but what it can buy is not. Person A's $180,000 is not worth what it appears on paper. After adjusting for inflation, its real purchasing power today is roughly $73,000. Not because of fraud, not because of bad decisions, simply because cash held over decades erodes silently, every year. Without exception, this is the invisible tax on doing nothing. Person B's portfolio is invested in assets that have historically outpaced inflation. The real annual return after inflation has averaged around 7% over the long run. 30 years of that rate still produces a transformative number. The cost of doing nothing is not just the missed gains. It is the slow, silent erosion of what you already have. So why do so many people avoid investing? The first reason is fear. Markets fall. Headlines predict disaster. Portfolios shrink temporarily. The fear of watching your savings disappear is real. It is powerful, and it is understandable. The second reason is complexity. There is an overwhelming amount of financial information online. Which platform? Which fund? How much risk? The paradox of too many options produces paralysis. People choose nothing because every option feels like the wrong option. The third reason is small numbers. $500 a month feels irrelevant when the end goal is over $1 million. People assume the math only works at a larger scale. The simulation says otherwise. The power is not in the starting amount. It is in the consistency and the time. $500 per month, 30 years, uninterrupted. The result speaks for itself. Markets have crashed multiple times in the last 3 decades. The dot-com collapse, the 2008 financial crisis, the pandemic sell-off in 2020. Every single time, long-term investors recovered. Every single time, those who stayed invested eventually surpassed the previous peak. Waiting for the right moment to invest is statistically identical to not investing. The best time to start was 2 decades ago. The second best time is now. What if Person B waited 10 years to start? Same $500 per month, same S&P 500 returns, but starting at 35 instead of 25. After 20 years, the portfolio reaches about $380,000. Not bad. But compare that to the $1 million outcome from starting a decade earlier. The cost of that delay is over $700,000. Think about why. The first 10 years of investing are not just 10 years of growth. They are the years when the smallest amounts gain the most time to compound. The earliest dollars work the longest. Consider a single dollar invested at age 25. It has 30 years to compound before retirement. At 10% annually, that dollar grows to nearly $17. Now consider the same dollar invested at age 35. It has only 20 years. At 10% annually, it grows to about $7. Less than half, same dollar, same rate, just 10 fewer years. The result is more than cut in half. Every year without investing is a year of compounding that cannot be recovered. The math does not offer refunds on lost time. The point of this simulation is not to make you feel behind. It is to show you what the numbers actually look like when you run them all the way to the end. Most people understand in theory that investing is better than not investing. But theory does not feel urgent. The difference between action and inaction feels vague, until you see it laid out year by year with real numbers attached to it. Nearly $1 million, not a hypothetical, not a projection built on impossible assumptions. A straightforward calculation based on 50 years of historical data and a $500 monthly habit. The gap is not created by luck or expertise, it is created by time. And time is the one resource that nobody can buy back. The S&P 500 has never produced a negative result across any 30-year holding period in its history. That does not guarantee future returns. Markets change. Past performance is not a promise. But it does mean that patience has historically been the most consistent factor in long-term investment outcomes. Volatility is not the same as permanent loss. A 20% market drop in year 10 is not a disaster for a 30-year investor. The shares bought in year 11 cost less. You are not losing, you are accumulating at a lower price. The real risk for most people is not a crash. It is never starting, because starting late is expensive, and not starting at all is permanent. Person A saved consistently for 30 years. That is real discipline. But the outcome compared to person B is nearly $1 million apart. And that gap came from one decision, not from chance, not from expertise, from where the money went each month. Your monthly amount may be different from $500. It may be higher. It may be $100. The principle scales. The math does not change. Time and consistency do the work. Consider what happens every year you delay. The money you would have invested does not sit waiting for you. It simply does not get invested. The compounding that would have started in year 1 starts in year 2 instead. And every year of delay pushes the entire timeline back. The final outcome shrinks accordingly. This is not financial advice. What you invest in and when is entirely your decision. The simulation is based on historical S&P 500 averages. The full calculation methodology and sources are linked below. Sources and the full simulation data are in the description. If this changed how you think about money, subscribe. A new simulation drops every week. The next one is already waiting.